The Federal Reserve, the same institution that let inflation rip straight through your wallet, is now floating the idea of a new bailout facility for hedge funds. That's right. While average Americans drown in credit card debt and struggle to put food on the table, to put a roof over their head, we've got the Federal Reserve considering a program to bail out Larry Fink and all of his billionaire Wall Street buddies. What could possibly be their justification? Maybe some of their trades blow up, or heaven forbid, they lose money in the future? This isn't capitalism. This is cronyism on steroids. And I'm going to explain exactly how they could be screwing you over in 3 simple, fast steps.
Step number 1, we have to start by going over the basis trade. Now, to make this even more infuriating, this proposal for a hedge fund bailout that's being put forward by these expert economists only applies to maybe 10 or even fewer hedge funds. More on that in just a moment. But we're going to start by going over everybody's favorite, or actually it's not everyone's favorite BlackRock CEO. It's his cousin, forgive me. It's not Larry Fink, this is Ferry Link right here in the middle. And he runs one of these hedge funds that takes out 1,000-to-1 leverage, maybe not that extreme, but let's say 50-to-1 leverage, and could potentially in the future need a bailout from the Federal Reserve. But of course, he's cousins with Larry Fink, so he's an insider. He's a crony with all of the central planners. So how does he put on this basis trade? Okay, well, first and foremost, he borrows the money. So he goes into the repo market, and let's say he borrows $99.90, but he has to pay 9 cents in interest. So total, let's just say he's borrowing $99.99. You say, well, George, he needs the collateral to go ahead and get that loan to begin with. Oh, yes. This is where the magic comes into play, the magic of financial engineering. So Ferry Link doesn't have the treasuries to begin with. No. What he does is he borrows money, then he buys the treasuries from your drunk, insolvent Uncle Sam. Then he spends the money into the economy, distorting it even further, making your life worse or reducing the standard of living. And then Ferry Link takes the treasuries that he just purchased from your drunk, insolvent Uncle Sam, and he uses them for the collateral for the loan where he got the $99.90 to begin with. I mean, this is complete insanity. So just make sure we're all on the same page here, because this is so insane. The collateral for this loan, Ferry Link doesn't have it to begin with. So he borrows the money first to buy the collateral, then he posts the collateral. So now Larry Fink's crony cousin has this treasury on his balance sheet. So he notices there's a slight arbitrage. So in the futures market, this same treasury is trading for, let's say, $100. But he just purchased the treasury from your drunk, insolvent Uncle Sam for $99.90. So what he does is he basically sells this treasury at a higher price in the future, or he agrees to sell it at a higher price in the future. He takes the $100 and then he uses that to pay back his repo loan. Remember, with the interest rate is $99.99, and then he pockets the 1 penny. Now, before we go any further, I want to point out that in 2020, this trade already blew up. And basically, Ferry Link got a bailout from the Federal Reserve by them going in and doing quantitative easing and buying what they call off-the-run treasuries. But back then, the entire trade was maybe $500 billion. Today, it's over $1 trillion. Step number 2. So now let's go over the risks involved here. And for this one, you're definitely going to need to sit down and pour yourself that stiff drink. This is where it gets completely insane. So we go back to Ferry Link right here in the middle. And actually, first, let's go over the risks in the repo market, because in step number 1, I kind of went over a broad overview as to what's happening here. But what I didn't explain is Ferry Link is having to roll over this loan, let's say every 2 or 3 days. So here's how this works. He borrows the $99.90 to buy the treasury. You guys remember that. But the very next day or 2 or 3 days later, he's got to pay that back with interest. Now, he doesn't have to pay back with, let's say, 9 cents of interest, but let's just say a penny to keep this example super simple. So on, let's just say, the 3rd day, he's got to pay back the $99.91. And again, that's the $99.90 plus the 1 cent of interest for the 3 days. And so what is he doing here? He's rolling over the debt. That's another way to say it. So he's borrowing the $99.91 to pay back the $99.91. Then 3 days later, he's borrowing, let's say, $99.92 to pay back this loan. And 3 days later, he's borrowing $99.93 to pay back this loan. You guys get it. And what he's factoring into the original equation is at the end of 1 month, so I changed it up a little bit, made it more specific. Let's assume this future contract, the maturity date is 1 month from today. So that's when he factored that he would have to pay the full $99.99, which would give him that 1 penny of spread. So you can probably see where this could go horribly, horribly wrong. That's if rates in the repo market spike, like we saw in September of 2019. So he's got to roll this over daily, but at the end when the contract expires and he gets the $100, let's assume now that his interest rate has gone from 9 cents up to $1, $2. Well, now all of a sudden he would owe, let's say 101 or 102, but he only has 100. He loses on the trade. So before that would happen, he would likely get a margin call from the counterparty in the repo market where they would take that treasury away from Mr. Link. Okay, well, if they take the treasury away, then what does he have to deliver to the buyer of the future when the contract matures in 1 month? That would be nothing. And let's remember who the buyer likely is. It's probably a pension fund, potentially your pension fund. So then the question becomes, well, why would your pension fund buy a futures contract for treasuries instead of just buying the treasuries themselves? Ha-ha! Because they can use 5,000 to 1 leverage. So your pension fund is levered to the hilt, and Ferry Link is levered to the hilt, and you have all of these counterparties involved in the transaction. What could possibly go wrong? Oh, that takes us to the next component of risk, and that's a margin call from the dealer or the clearinghouse. This gets extremely complex, and obviously I'm oversimplifying it. But let's just assume for a moment that Ferry Link, he owns a treasury that he bought for $99.90. So he is long that treasury, that cash treasury position. Okay, got it. So then he sold a futures contract for $100. So basically he is short this position. So if, let's just say, the price of the futures contract goes down to $97, then on paper, Mr. Link would have a gain. But what happens if that spread actually increases? So as an example, let's assume for a moment that interest rates go up. And you guys know there's an inverse relationship between interest rates and the price of a bond, including a treasury. So let's say interest rates go way up because of a lack of liquidity in the treasury market, like we saw during the cerveza sickness, and the price of this treasury that he owns goes from $99.90 all the way down to $90. Now what's going to happen? That dealer is going to see that, and they are going to issue another margin call. So they're going to say, hey, Ferry, you need to give us a little more collateral here. And then Ferry says, I don't have any. And then the dealer says, well, not our problem. So right about now, you would assume the dealer here, the clearinghouse, would take this treasury because that's what they need to deliver it to the buyer in 1 month. Unfortunately, you'd be wrong because they don't have legal rights to this treasury because it's been used as collateral in the repo market. So what would the dealer do? They would take the contract away from Ferry and they would sell it to another counterparty that had a lot less risk. Whatever margin they had in their account would be taken away from them, and Mr. Link would be sitting on that loss, including the loss from his long position going from 99.90 down to 90 bucks. Oh, but wait, there is more, believe it or not. Let's just assume that liquidity dried up like we saw in 2020 during the surveillance sickness for these treasuries. Okay, well, think it's a margin call from the repo market counterparty, going back to that scenario. So then the treasury goes back, but they lent out $99.90, but they're only getting back a treasury that's valued at $90. And what happens if the liquidity's not there? They might not even have a bid, assuming that it's an off-the-run treasury. So then that blows up their balance sheet and potentially impacts the entire repo market, which would impact global dollar liquidity, making the problem 10 times, 100 times, 1,000 times worse. And let me be very clear, I am massively oversimplifying this. So when it comes to actual systemic risks in the financial system, I am just addressing the tip of the iceberg. Step number 3. Now let's go over their proposed plan to add another facility to the Fed to specifically bail out these hedge funds, just like the BTFP was added to bail out the banks back in March of 2023. So we all know what's happening here. It's whatever the facility is, however they engineer this, however many bank reserves they create, lower interest, whatever it is. The bottom line is this is going to fall onto the shoulders of the Federal Reserve because they're the only ones in this game that have a balance sheet that is infinite. They can also have negative equity. They can lose money. It doesn't matter. They can create as many bank reserves as they want. So that goes without saying. You guys know. But what's more interesting is to think through the fact, and I'm sure most of you watching this video right now are saying to yourself, well, even if the Fed steps in, I mean, there is no way this ends well. This is inevitably going to end badly. And by the way, the responsibility is at the end of the day going to fall onto the shoulders of not necessarily the Fed, but you guys know who's going to pay for this. It's going to be the U.S. taxpayer, because it always is. They're the ones that get screwed. The average Joe and Jane, just like you watching this video right now. So I think the more important question is why? This is really the key to the whole video. Why does Ferry go out there and take all this risk and lever up? Is it because greed is something that's brand new on Wall Street? Absolutely not. Why is it that the repo counterparty is willing to do this trade back and forth? Why is it that dealer Dan, I know he's greedy, you can tell by his eyes being money signs, but why is it that he is willing to get in the mix? And why is your pension fund willing to go out there and take 5,000 to 1 leverage or whatever it is in the futures market instead of just buying the treasury? I mean, what is going on here? Is it just the simple fact that these counterparties and these entities are greedy? No. People have been greedy for thousands of years, and they'll be greedy thousands of years into the future. The reason why all of these counterparties are willing to take such extreme risks is because they know at the end of the day, the Fed will bail them out. Because the Fed has been bailing out the financial system going all the way back to the late 90s in long-term capital management. So if or when the Fed comes in with this new bailout facility for Ferry Link and all of the counterparties, it's just going to increase the risk taking, and it's going to increase the systemic risk, which at some point in time will blow up. At some point in time, this will collapse just like that Jenga puzzle in the movie The Big Short. And to be crystal clear, it's not because we don't have the right bailouts. It's because we have bailouts to begin with.